So today we're going to be talking about where's the multifamily market today? Why is it important to continue to evolve the model even after experiencing success? And what is PassiveInvesting.com's evolved multifamily model in 2024 and beyond? And also, I want to make sure that this is interactive. I don't want to sit here and talk at you for the entire hour. So as you think of a question, put it in the chat box or the Q&A. I'll be checking both areas. And I just want to have an open discussion about, what are y'all seeing in the multifamily market? What are we seeing? What am I seeing? What are we focusing on? And how can we, experience success in 2024 and continue to kind of push forward and make stuff happen. So, we got somebody from Toronto. That's our first international of today. Good to see you from Toronto, Addie. And KP from Jersey City. Thanks for coming. So on the multifamily market today, and we'll just go ahead and jump right into it. Obviously, 2023 was a challenging year when you look at, in comparison to 2022 and 2021. And I guess just to introduce myself first as well, in case this is maybe your first webinar, you haven't met me before. My name is Eric Fitzgerald. I'm the Director of Acquisitions for PassiveInvesting.com. I've been with the company about 3 years now. I've done $1.4-ish billion worth of transactions. I started my career in property management in Pennsylvania, working for a company called Morgan Properties out of King of Prussia, Pennsylvania. Moved down here to Charlotte, worked as an analyst for a multifamily firm, and then worked as an associate for a family office doing C-class and B-class acquisitions in the Southeast. Met up with Dan and Danny actually back in 2019 and kind of stayed in touch. Actually met them through the Multifamily Investor Nation platform. So it's always a cool full circle moment to be able to host these webinars and try to give back a little bit. So yeah, I've been with the company about 3 years. I live in Charlotte, North Carolina, and primarily focused on multifamily at this point, as well as I lead our car wash team as well. So happy to be here. But on the multifamily market today, obviously, last year being a much slower year than we had historically seen in 2022 and 2021. Our team, we underwrote about 400 deals. We sent offers out on about 85 different offers. So that was actually just about the same amount of offers as we sent out in 2021 and 2022. The difference with 2023 is that we actually did not buy a deal in the entirety of 2023. We did not buy a multifamily deal, even after sending out 85 offers. So the reason for that being obviously interest rates rising, seller expectations of pricing, especially in the beginning of 2023, were quite high and not in line with what buyers were able to pay. Now, we saw that come down a little bit in terms of seller expectations over the year of 2023 to where by the end of 2023, we got really close on a deal. We got a deal actually under LOI, and we're really starting to get more traction in terms of being where sellers' expectations are. Now the projections of interest rates for this coming year are that interest rates are going to come down. That should further increase, buyers' ability to get up to where market pricing is. And I think market pricing has come down significantly enough to where, by the end of 2024, I feel that there is going to be a fairly active transaction environment, particularly when you look at the amount of capital that was not allocated last year in 2023 and needs to come out in 24. So all these things are kind of combining to make, I think, probably a slow Q1, probably a slow Q2. But I think when we hit Q3, Q4, hopefully interest rates are coming down at that point. Now, they're not going to be cut to zero like they were, but it's going to be probably a gradual, slow decline to where we're kind of within the normal range of historical averages, not the, locking at 2.8% agency debt anymore, but maybe 5%, maybe 5.5%, something more accretive for buyers, but also, not egregiously low like we saw over the last, 18 months. So excited about that. I think that's the positive outlook, and that's kind of the camp that I'm in. I think there is going to be opportunity as well. So this is maybe some of the negative for sellers, but positive for buyers where, you know, some deals are going to be distressed. And so we saw in 2023, you know, a good number of deals come to us. You know, one came to us with, hey, you know, the pricing is essentially the value of their debt, and that's what they want for the deal, and they just need to get out of the deal. And can you get to the price of their debt? And in that particular scenario, we couldn't even get to the price of their debt. But you know, I think that continues into 2024, where, you know, if you are focused in on building relationships with brokers, sellers, you want to be that first phone call that's like, hey, you know, this guy's finally coming to reality. You know, he wants, you know, 200 a door for this deal. He bought it for 235 a door, and he just needs to get the value of his debt out, and his investors paid, and he's good to go. So I think there will be opportunities like those, and we're constantly communicating with brokers and sellers to try to be that first phone call to make sure that we're getting called when those opportunities come up, because they will be coming in 2024. There's kind of this wall of maturities coming of some different types of loans, some bridge loans coming due that are you know, going to potentially be in some trouble. So we're getting prepared for that on the acquisition side. You know, one thing that we're focusing on is really the Class A space. I do think in the Class C space, we're going to see quite a bit of distress for a few different reasons. We've got, you know, increased delinquency in those Class C deals. We've got this kind of CapEx tsunami coming, which is coined by a guy, Bill Ham. I can't take credit for that terminology, but he calls it the CapEx tsunami. And basically, it's all these Class C deals that have been, you know, bought and sold and kind of put lipstick on the pig, you know, for a metaphor. And they're kind of not really taking care of the main issues on the property. And, you know, some of these buyers are going to kind of get caught holding the bag in terms of like, now this property needs a huge plumbing upgrade, or you know, the new roofs and you know, all these kind of exterior functional CapEx items that are not the appliances and flooring flip that all the kind of Class C syndicators have been flipping in and out of over the last few years. So I think that is going to come to reality, the Class C space, along with the fact that the majority of those were financed by bridge debt, and they can't get the rent bumps, and there's increased delinquency, and there's all this CapEx coming. So those factors are kind of joining together to create a not great, you know, not great ingredients for the Class C space, I think, moving into this year. So if you look at it from a buyer's perspective, that could be, you know, opportunity. You know, we are not really interested in the Class C space. We still feel, you know, Class B plus, A minus, A class real estate is where we want to be. That's the institutional level real estate. That's the larger buyer pool for these assets. And I think in the Class C space, you have to think about who is your end buyer, right? And so that's something that we try to think about when we buy a deal is, you know, does, you know, Blackstone want this deal? You know, does, you know, some of these larger institutions that show up all the time on our bid sheets when we sell deals, you know, we want to make sure that we're, you know, we have that kind of buyer pool on the exit of a lot of these properties. So that's one thing we're thinking about. You know, as far as how our model, and please, you know, put in questions as you think of them. You know, again, I'm just kind of talking through how our feelings are, all that kind of stuff. I see a question from our Menon. I'm sorry if I mispronounced that. Given the rents had gone up a lot after COVID and the fact that inflation is coming down, et cetera, we are seeing some areas with zero negative rent growth and solid areas such as DFW, Phoenix, et cetera. How do you adjust for rent growth in general? Let us say it is a B location and C or B property. So this is a great question. So rents have certainly slowed down. And not only in your underwriting should you be adjusting the organic rent growth, like the, you know, 2%, 2.5%, 3% year over year organic rent growth that people have been underwriting, but that's, you also need to take those facts into account on your rent bumps, on your renovations. If you're doing, you know, renovations on a property and you know, the seller is saying you can get $250 rent bumps by spending, you know, 10 grand on the unit and blowing it up and doing all that kind of stuff. You need to factor that rent growth into your projections as well. So We are certainly being conservative, to answer the first part of that question. So, he said DFW Phoenix in solid areas such as those, how do you adjust for rent growth in general? So we we use a service called CoStar and Yardi, and we kind of combine those two services to look at net absorption. And so net absorption is basically the one supply and demand metric that kind of integrates how many units are being built and how many apartments are being rented. If you have positive absorption, that means there's strong demand and there's more apartments being rented, more apartments being demanded than supplied. If you have negative absorption, that is not a good thing. That means there's a lot of supply and not enough demand to meet that supply. So supply and demand, it's very basic, but it is extremely important when looking at rent growth. So for example, if we're looking at South End Charlotte is a submarket here in Charlotte where it's the largest supply coming online as a percentage of inventory in the entire United States as a submarket. So when we're looking at a deal in South End, even though there's a reason for this supply, right? So everyone's moving there. Anybody from the age of 22 to 28 is moving into South End Charlotte. Except for me, I live in Uptown because I'm not one of those. But everyone's moving there. There's a ton of demand, but when we're looking at a deal in South End, we're not saying, oh, there's so much demand, the rents are going to go through 3%. That market has so much supply coming online in the next 3 months. And I'm looking out my window now, and I can see 4 apartment communities under construction in that submarket right now, just from my little window here. It's a concerning thing. So if you're looking at a solid location, even if it's solid in the terms of the name, like Phoenix has always been solid, but if you actually look at Phoenix, and we're not in Phoenix, so I'm not super in tune with it, but the things I've seen on Phoenix is that they're actually seeing that negative rent growth, and just because the market or the submarket has a good name and it historically has been strong, you still need to dive in on that net absorption and see what is projected over the next 3 years. Is that supply continuing? Now, nationwide, supply should decrease over the next 2 or 3 years, since there have not been as many development projects popping up due to interest rates. So once this kind of wave of supply hits, by maybe the middle of this year, end of this year, 2025 and on, that supply should be significantly decreased. So I think it's probably a short-term issue in terms of supply. And if you can find, a good deal for a good basis and a good market and underwrite really conservatively for those first, that first year or two, I think you'll see in a lot of markets, and this is, again, market dependent, this is nationwide kind of broad stroke, but supply is projected to decrease pretty substantially. So, we're in buy mode. We're looking at markets like DFW. We're looking at the historically strong markets, but for 2024 and probably a little bit of 2025, we're being very, very conservative in terms of rent growth and looking at that net absorption and making sure that everything is, positive, and making sure that demand is outpacing supply. And if it's not, then you probably will see some of that negative rent growth that we're seeing in some markets now. So I hope that helps answer that question, and feel free to follow up if I missed anything there. On how we are evolving our model in 2024. So we are really starting to focus on relationships, and we have in all of 2023. We feel like the deal blast from major brokerages where they blast out the deal through email to every buyer on planet Earth, that is not the way to find deals. We've always kind of felt that way. So what we're focusing on is, the relationships that we built with sellers we've transacted with, brokers that we've transacted with. We're really focusing in on our major markets, where our portfolio already is, where we can, have economies of scale and underwrite a little bit more aggressively on some expenses, because we know we know the market. We have a property right down the street, and this is what we pay per door for, payroll or landscaping or some of the utilities or anything like that. So we're getting really granular in terms of markets, trying to focus on, where our existing portfolio is. And we're also focusing on keeping our options open in terms of debt. So, if we're looking at a deal and maybe it's a lease up deal, and we're not completely disregarding maybe a bridge execution if it makes sense, or an agency execution if it's a stabilized asset. So we have Ed Gilmer on our team on the capital markets side, and we're constantly evolving and constantly keeping our options open in terms of what debt we want to put on different deals, depending on the deal story and the deal size and all these different kinds of things. So I think that's an important, distinction, is that we're trying to keep our options open on debt. We're not strictly going agency or strictly going bridge. I think the idea with bridge is that you go in, it's a more flexible interest rate. You buy an interest rate cap, and it's projected that interest rates will decrease, and maybe you can refi after executing a business plan, or even put a 2-1-1 type of hold period, so you're good for 4 or 5 years and you don't have to worry about it. You just buy the interest rate caps and you budget for that. So there's different kind of strategies that you can use. And like I said, we're not committed to any one debt strategy. I think that kind of pigeonholes you and doesn't allow you to try to get creative and match the right debt to the right kind of deal, because no two deals are the same. There's always a different story, and different kinds of debt can help or hurt you in different kinds of deal stories. So I talked about the relationships. Practically what we're doing to try to help some of you who may be starting out and saying, well, I haven't done $1 billion worth of acquisitions over the last couple of years, and I don't have that kind of name brand recognition. So practically what we're doing is we're setting up reoccurring reminders, and we're putting in a service like Asana or Monday can do this, Monday.com, and just put all the contacts in of all the brokers that do deals in your market, that make things happen, and make sure you're touching base with them every week, every 2 weeks. And we're taking them out to lunches. We try to send them nice holiday gifts, and you really just be genuine with them. Just sit down, have lunch, have dinner, tell them what you're seeing, hear about what they're seeing. If they have a deal, underwrite the deal, give them, quality feedback on that deal. That's probably the best way to have an introduction to a broker, is actually just look at a deal that they have, underwrite the deal, analyze the deal, ask some intelligent questions about the deal. Don't just reach out and say, hey, I want to buy some stuff, and, here's where I am, here's what I'm looking for. It's less effective than saying, hey, saw this listing you had at 123 Main Street. I know you're looking for 15 million. I'm penciling out at 10 million. Here's why. Here's the cap rate I'm underwriting to. Here's my rent growth expectation. Just be transparent with them, and maybe if you have special local knowledge of the market, say yeah, I drove past this deal, or I drove this deal and I drove the comps, and I think the rent upside isn't quite there because of this comp and this comp. So that's a good way to just introduce yourself to a broker, try to start building that relationship, because like I said, it's going to be extremely important moving into 2024, is these relationships. You want to be on that kind of top, and I'm not naive enough to say they're only making one call. So you want to be in the top 10 of their buyers, so you're getting that kind of top list. Hey, I have this deal, it's off market, let me know where you can get to, type of thing. And they're going to send that to the people that they have the best relationships with and that they know can execute. So there's going to be a lot of those opportunities this year. We're really focusing in on inside of the Class A space, on merchant developers and regional and local developers who develop to sell. And I think that's one of the easiest ways to get deal flow in this environment. Is there's still groups that are finishing up developments that they started a year and a half, 2 years ago, and they build to sell, so they are market sellers. And so if you can get to them, or have a relation with a broker who can get to them early, before they kind of survey the entire market and blast the deal everywhere, you can get an early look at a deal from a local or regional developer. Maybe it's a BTR, a 50-unit BTR deal that's like 10 million, or those kind of deal sizes. I think we see a lot of opportunity in, and we're not too big to say, well, we don't want to do a 10 or a 20 or $30 million deal because we've done $100 million deals in the past. We think a lot of the opportunities are going to be in that, smaller deal size range. And, that compared with trying to be flexible on debt, you can get, a good relationship with a developer who's maybe in lease up and is willing to sell at a very accretive basis for you to come in and take it down a little early, with bridge debt, and maybe it's not stabilized yet. So those are some opportunities that we see. Those are kind of what we're looking at in 2024. And again, happy to answer, any questions. I'm trying to, also apply this to you all. So if you're starting out, make sure you're building those relationships with the brokers. A simple CRM setup helps us do that. So we're making sure we're touching, each person that we need to every 2 weeks or so. Taking them out to lunch, taking them out to dinner, underwriting their deals, things like that. So those are some of the things we're looking for. But I'll pause there. We've got a ton of people in this webinar, which is always good to see. So I know there's got to be some questions out there. And if you ask one, somebody else is probably, thinking about the same question. So please, put down in the chat, put down in the Q&A, any questions you guys might have, and, open to sharing whatever, we're looking for, and hopefully add some value to y'all today. There are no questions. We'll go ahead and wrap up soon here. Let's see. Michael said, not a question, but similar challenges on my end on your opening statement. When under contract on multiple properties in 2023, after receiving financials, looking at a hard analysis, never came close to closing a deal. Lenders are not comfortable with most margins due to sell price, interest rates low. Yep, that's very accurate. Yeah, it's a tough environment, especially if you're kind of blind offering. A lot of our, like I said, we sent out 85 offers. A lot of our, some of our offers were kind of the blind LOI type stuff where the broker was like, hey, I think they're sellers. This is where I think they might be at. Let's see if we can figure something out. They would be interested by the offer. We'd receive financials, and, it just wasn't going to work. And I think your point about, lenders being kind of sometimes the linchpin there with not making the deal work is true. So that's why, like I said, we're trying to keep our options open with everything from, bridge, agency, life co, all kinds of stuff on the debt side. And luckily we've got Ed Gilmer on our team, who's our director of capital markets, who's kind of constantly, monitoring those different types of strategies and trying to make sure we get the kind of best execution that's possible. James Ray said, we're looking at replacing our CRM. Any suggestions? So we use a service right now called DealPath. It is quite expensive, and it's kind of like an all-in-one, deal management, deal tracking. And so that was really helpful for us, when we were doing, $500 million of deals in 1 year. But obviously with things slowing down, we don't really need to kind of have that big old system now. So, we're transferring over to Asana. We use Asana for some other functions inside of the business, some other departments. So we're probably going to be integrating into Asana. We've used Monday.com before, back in 2021 when I was first starting with the company, and that was a good service for us at the time. And I think we did $300 or $400 million worth of acquisitions on Monday.com. So that was a good service for us. So I'd say Monday and Asana are good solutions that we found so far. Tori said, I've heard from several sources that there will be a large number of commercial foreclosures in the market the first quarter of this year. How do you think this will affect asset classes and thus the acquisition approach? Yeah, great question. So I think a lot of this has to do with how willing lenders are going to be to try to work deals out. And so we've kind of heard through the grapevine and through some other operators that we're talking to, as well as some debt brokers, that lenders are amenable to, a lot of times, this is not in all cases, but in some cases, amenable to extensions on bridge loans, or kind of taking away some of the provisions to extend deals if there's a DSC test that the a property maybe is not hitting. So I think that's a good thing, and we'll see if that continues. I think if lenders continue to try to work with groups that have, nicer deals. I think it's more so in the Class C space. We're going to see more of those foreclosures and issues like that. But from what I've heard so far, lenders are amenable a lot of times to working with groups on the, Class B space, Class A space. This is a good, thing for obviously for what we're looking for. But yeah, I would say we're definitely going to see some trouble this year, some foreclosures. And I think if you're looking at it from a buying perspective, that's opportunity as a buyer to try to get some of these troubled assets that maybe. I think the important distinction is you want to find assets that are troubled, but only troubled maybe by financing. So they're troubled by rising interest rates. Maybe the group didn't buy a cap, but operationally, it's a nice deal in a nice location. Maybe it's a Class B or a Class B minus, and it's a nice area. They're still seeing rent growth. It's in a nice market. Those are the kind of deals that are the real opportunity to take advantage of. I think where people might get into trouble is if you see a Class C deal coming up and it's like, oh, they're in trouble, their debt is too expensive. But you look at their financials and their rents are declining. There's massive capex that needs to be done. There's high delinquency. These kind of things. It's important to not just look at the financing piece, but it's looking at some of the operational challenges that potentially some of these deals might have. So yeah, I think there's going to be opportunity, and we're ready to try to take advantage of some of that. And I think we'll have probably another slower year in terms of transactions, though. So I'm not expecting a huge year by any means for the market, but hopefully more opportunities in 2023 and lower seller expectations and lower interest rates, hopefully. Can you talk a little bit more about the net absorption rate? How do you use this to guesstimate the average rent growth and pro forma renovated units in market? Also, you mentioned Phoenix market may have some caveats. Can you please elaborate on that? I've heard that population growth is good, but job growth may not be as good as, say, in DFW. Yeah, so Phoenix, again, like I said, I don't have, I'm not an expert on Phoenix. We haven't looked in Phoenix. We haven't gone that far west. Some of the things that I've heard from brokers is that the rent growth there is actually negative. And I think the primary reason for that is that net absorption. So they're seeing negative absorption. So the supply is higher than the demand. Therefore, rents are going down. Demand is not as high as projected. And that could be because the job growth is not as good. Again, I'd be guessing if I said why that is. But I from what I've heard, it is because of just the massive supply that has gone online in Phoenix over the last year and a half, 2 years. And we're seeing the effects of kind of that COVID rent growth slowing down and things like that. So I don't know if it's a job growth. Like I said, I don't know enough about Phoenix in particular. But what I've heard is that it is a kind of a supply issue there that is causing rents to be negative. And how do you use net absorption to guesstimate the average rent growth and pro forma renovated unit rents in a submarket? So CoStar, Yardi will have this net absorption kind of data. And if I'm looking at a net absorption kind of graph where you see the supply of the units versus the demand, and if it's positive or negative, if I'm seeing negative absorption, that means pretty much negative rent growth. And if I'm seeing positive absorption, usually that means positive rent growth because there's more demand than supply. It's important though if you see positive absorption, that does not mean you can automatically underwrite 3% or 4% annual rent growth on a deal. You still need to look at that sub-market. You need to look at any supply that's coming online, and that net absorption will usually have like a 5-year chart out in the future about what's demand projected to be, what's supply projected to be. And like I said, pretty much nationwide, when you hit 2025, that supply line is going to come down and that demand is kind of slowly creeping kind of ever so slightly up. So we should be at a good spot kind of 2025 and on in terms of supply. So I think that helps you when you're looking at deals in 2024 is pricing should be discounted. You should be able to find a good deal at a good basis and be able to see some of that positive rent growth in 2025 and on kind of after we get past some of this supply that's still coming online from the big wave at the top of the last cycle. So hopefully that helps. Where do you guys see exit cap rates for Class A and B properties in 3 to 5 years? Seem to be the most difficult question right now in underwriting. I know the cap rates will differ by market. Yeah, if I knew the answer, I would be on a beach somewhere, living it up. But I think if you look at where the data is, obviously it differs by market. But if you're looking at a Charleston or a Charlotte market in 5 years and a Class A deal, 3 to 5 years and a Class A deal, I think it is a supportable thing to say cap rates should be lower than they are today. Now that's not something that we're underwriting for, but I think if you look at where rates are now, kind of historical highs in the last cycle, and you look at where supply and demand are going in 2025 and beyond, as far as supply being pretty low, demand coming, relatively higher than supply in 2025 and on, that should create an environment where, interest rates are lower, demand is higher, supply is lower, and cap rates should trend in, the lower direction moving on in 2025 and on. Now that's a difficult thing to say. It could be, completely opposite. There could be a war and something could happen, and all kinds of crazy stuff could happen. But I think when you look at the data, it's a supportable thing to say that cap rates should be about the same or maybe a little bit lower once interest rates come down and supply kind of decreases and you're looking in the right markets and things like that. So hopefully that helps. Again, no way to kind of accurately say that, but I think that's kind of my personal feeling, and we'll see where things go from there. Again, but not underwriting for that. And I wouldn't underwrite for a lower cap rate exit at all than what you're buying for. Dennis said, what are you seeing regarding LTV today? We're seeing like 60 to 65% generally. 65 is probably a little bit of a push, but obviously depends on the deal. But probably low 60s is where a lot of stuff is penciling out, and lenders are really focusing in on your entry cap rate and the basis that you're buying, and is it supportable by other properties in the market? Is the rent growth that you're underwriting supportable by other properties in the market? So lenders are definitely underwriting pretty conservatively. Steve asks, what is the definition of positive absorption? Just when demand outpaces supply. That's a simple way of saying it. Tori said, what is your typical fundraising spread, bridge versus crowd versus private versus traditional, or what would you consider a balanced model? Usually we will have, so all of our assets are, all of our equity is raised in the syndication model. So that's private accredited investors. Average check size is like 150,000. So we're typically bringing, the difference between our LTV and the purchase price in equity. So that could be, our LTV is maybe 60 to 70% in this environment. So 40 to 30% of that equity is coming from private accredited investors. That is all the questions that I see. If there's any last one or two, I'll hit those, and then I'll let everyone get back to their Tuesday. Hope everyone had a great New Year, a great holiday, and we're looking forward to really hitting the ground running here in 2024 and making some stuff happen. So I hope this was helpful to everyone. Again, please feel free to email me. My email is eric@passiveinvesting.com if you have any questions or feedback on the webinar. And Dennis says, go Eagles. It's a great way to end this webinar. They're going to turn it around, and we'll see some success. So thank you, everybody, for joining, and have a great day. Thank you.